Welcome, beginners. If you don't understand a single thing about Forex or even know what it is, I suggest you go to my previous video on Forex introduction. It's 9 minutes long and it will bring you up to speed. But through this video, I'll be explaining how do you know when to buy or sell a currency pair, what is a lot and trading in lot sizes and margin, what is a pip, what is a bullish or bearish candlestick. If there's anything throughout this video that some of you would like me to do an extended explanation of, feel free to leave a comment below this video. This topic: know when to buy or sell a currency pair. For example, Euro USD. The euro is the base currency and the USD is the code currency. We should understand this by now. So this is the basis for the buy or sell. If you believe that the US economy will continue to weaken, which is bad for the US economy, we would execute a buy Euro USD order, which will look like this. Is the MT4 desktop version of MetaTrader. This is the Euro USD currency pair, and if you believe that the US economy will continue to weaken, which is bad for the US dollar, you would execute a buy Euro USD order. This is the order sheet. This is the symbol, aka the currency pair. This is the volume, aka the lot size. This is the lowest lot size you can trade any Forex currency pair at. The stop loss has to be below the current price in order to execute an order with a stop loss. By doing so, you have bought euro with the expectation that it will rise versus the US dollar. On the other hand, if you believe that the US economy is strong and the euro will weaken against the US dollar, you would execute a sell euro USD order. It will look like this. Similar, only thing that the stop loss has to be placed above the current price in order to execute with a stop loss. By doing so, you have sold euros with the expectation that it will fall versus the US dollar. An advantage you have from using the desktop version of MetaTrader 4, you will be able to drag your stop loss and you'll be able to see what you are risking in US dollars. Another quick example, we are going to look at the USD JPY, which is the US dollar Japanese yen currency pair. I will be using the mobile MetaTrader 4, and in this example, the US dollar is the base currency and the Japanese yen is the code currency, which is the same basis for the buy or sell. If you think that the Japanese government is going to weaken the yen in order to help the export industry, for example, you would execute a buy USD JPY order. By doing so, you would have to click the order sheet at the top, and the order sheet is similar to the desktop version. It shows you the currency pair that you are trading. It shows you the lot size. You have your current price, and entering a stop loss, it has to be below the current price in order to set a buy order. And by doing so, you have bought the US dollar with the expectation that it will rise versus the Japanese yen. On the other hand, if you believe that the Japanese investors are pulling money out of the US financial market and converting all their US dollars back to yen, and this will hurt the US dollar, you would execute a sell USD JPY order. You go to the order sheet again, you would enter a stop loss, and it would be above their current price in order to sell with a stop loss. And by doing so, you have sold the US dollar with the expectation that they will depreciate against the Japanese yen. And to the next topic. What is a pip? You've probably heard the terms pips, points, pippets, and lots thrown around, and now I'm going to explain what they are and show you how their values are calculated. Take your time with this information, rewind or pause as much as you need, as it is a required knowledge for all forex traders. It is crucial for knowing your risk, even though most meta traders will calculate the risk for you, so I won't spend much time explaining this. The unit of measurement to express the change in value between two currency is called a pip. Simple as that. It is the unit of measurement to express the change in value between two currency is called a pip. For example, if the Euro USD, for argument's sake, the price is 1.1050 and moved up to 1.1051, that 0.0001 USD rise in value is 1 pip, which is only a fraction of the price movement. If price goes up 1.1052, that 0.0002 USD rise in value is 2 pip, and so forth. Moving on. What is a lot and margin? A lot and margin works hand in hand. Forex is commonly traded in specific amounts called lots, are basically the number of currency units you will buy or sell. A lot is a unit measuring a transaction amount, otherwise called the volume. When you place orders on your trading platform, orders are placed in size quoted in lots. Margin, on the other hand, is the capital or amount of cash needed to open a trade and stay in the trade. If your capital goes below a certain percentage, the broker will stop you out of the trade, and that is called a margin call. Lot sizes varies to brokers and the account that you have agreed on creating when signing up. There are 3 major lot size to determine the value of the movement in price, which is pips. Try not to overthink this information. It is crucial to know, but can be avoided using specific meta traders that will calculate these information for you, or use an online forex calculator. Trading with leveraged account. In forex, leverage allows traders to control larger positions with a smaller amount of capital. Capital meaning the amount in your account. Based on US based currency pairs, remember that lots are the unit of measurement, and this is how they are calculated. Standard lot is 100,000 units with a volume of 1.00 lot. This equals to 100 USD per pip. Please don't get confused. There's nothing confusing about this information. A mini lot is 10,000 units, volume of 0.10 lot. This equals to 10 USD per pip. A micro lot is 1,000 units with a volume of 0.01 lot. This is equal to 10 cents per pip. So let's do some maths. I won't go too far into the calculations. We had bought Euro USD, the price went up 2 pips. If we had used a standard lot, which is 1.00 volume, we know that 1 pip equals 100 USD. So this is multiplied by 2 pips, which equals to $200. Sounds good until the market decides you were wrong about the direction and drops 2 pips. Then your account would be negative $200 USD. Crazy, isn't it? If we had used a mini lot, which is $10 USD per pip at a volume of 0.10, then 2 pips would equal $20 per pip, and same vice versa if it goes against you. If we had used a micro lot, which is 10 cents per pip at 0.01 volume, the 2 pips would equal 20 cents. You get the math? If not, and you just simply don't like math, that's where voila that. Just go to a pip calculator and input the currency pair that you would like to trade, the lot size, and the amount of pip you would like to risk or interested in gaining. So it works both ways. It will tell you the amount of pips you are risking or trying to gain. MT4 platform on a computer will show you the amount you're risking on chart only when adjusting the stop loss after you have placed an order, but the mobile version won't. MT5 platform will show risk in USD and pips if you're using a buy limit or sell limit. TradingView on the other hand will show you what you're risking in the order sheet. And there are a couple other meta traders, but these 3 are most popular. Low-key just taught you a little bit about risk management. What is a bull or bear candlestick? The term bull, bear, or candlesticks are terminology for what we will see on the chart. Let's start with candlestick. What makes up a candle is the wick, which is the movement in price, and the open and close of price, which makes the body of the candle. Hence the term candlestick. Simple because it looks like a candlestick. A bull candlestick is determined by where the price opens and closes for the candle, and vice versa for the bear candlestick. This term bull is the movement of price upwards, hence the candle is bullish, and if the price of the candle moves downwards, the candle is then considered bearish. And that should be simple stuff to understand. Bullish and bearish candlesticks. And if you have made it this far to the end of the video, you can like, subscribe if you're willing to learn more about Forex.